Start it.
All right. Thank you, Kim. Good afternoon. Thank you for joining us today. My name is Natalie Wolf. I'm Director of Investments at Foundation for the Carolinas. And on behalf of the executive team, leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the Q&A window. The Mercer team will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you after the webinar. The webinar is being recorded and the link will be added to the fftc.org website. You can access it by going to the menu and the link is under Engage, Events and Webinars. I will now introduce you to Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the fourth quarter of 2022. Take it away, Travis.
Thanks, Natalie. Hi, everybody. Great to be here with you all again today. I'll go through our regular recap, give you a sense of both the quarter and the shakedown of the year, give you a few thoughts on the beginning of the year, where your pools have performed, as well as some thoughts on the future. So why don't we get started here? So just as a brief recap, 2022 in its entirety was pretty, shall we say, interesting, if not challenging over most of the course of the year. We did see a full calendar year of negative equity returns and negative fixed income returns, probably at these magnitudes for the first time ever. And that resulted in negative equity returns, which you'll see in the next page here, double digits, as well as fixed income returns at double digits. And there was no shortage of things going on over the course of the year. If you can't read these, it's okay, but the notion is that we had a bunch of things add to risk at the beginning of the year, things like another COVID scare, and certainly the fortunate start of the Ukraine conflict. And then throughout the year, we had a couple of respites of confidence where perhaps inflation, market priced in that inflation might be getting back under control as it did in the midsummer, or a similar vein and maybe not so dire economic environment as we saw in the fourth quarter through October and November. So while the year itself was down, there were periods of strong returns. And thus far here in the first part of this year, January and into the first few days of February, we are seeing a continuation of reasonably strong returns with a rotation of leadership, which was another key characteristic that we saw throughout 2022. The period in the middle of the year was led by, the growthier part of the marketplace. The fourth quarter rally was really led by the value part of the marketplace. And so far here in January, we're seeing these higher expectation growth-oriented stocks perform as well again. So if anything, as we think about the future and what we can take away from the most immediate past is we do think that this kind of volatility likely continues as the market gets their arms around inflation and the direction of interest rates, and certainly the pace of the economy, labor, and the rest. So I'll spend some more time on that in just a minute. But if we move forward here to quarterly returns, so global equities did rebound in the fourth quarter. U.S. stocks were up about 7%, really very little difference between U.S. large cap and small cap stocks. And international stocks performed extraordinarily well, both on a local market basis. We did see strong returns in places like Europe, where a more moderate winter and less economic impact from the cost of energy helped the stocks locally perform. And then the US dollar, which had been on a tear against most foreign currencies over the course of the year, did start to retrace a bit in the fourth quarter. That helped support those developed market index returns of EFA, as well as the emerging market index returns of the MSCI EM. We did, though, as I mentioned, we did see pretty significant downturns over the course of 2022 in its entirety. U.S. stocks, as measured by the Russell 3000, down about 19%. and EFA stocks, which measures the developed markets outside the US, down about just shy of 15, with the EM markets down 20. So it's a pretty difficult place, pretty difficult market to operate in. At the same time, we did experience a pretty meaningful increase in interest rates. Basically moved from 0 to about 4% on the short end of the curve over a 12-month period. And that continues on into the first part of this year. We have seen another quarter-point interest rate hike more recently. And so that put a lot of pressure on broad investment grade bonds. On the flip side, just above our circle here, you can see a 1.5% return for T-bills. We actually have some return from cash, which is not something we've seen for some period. So the price of money is no longer free, and that's created some downdraft, but it has certainly helped to change the forward-looking view, as well as provide some income to those investors that need income today. Some of the asset classes at the bottom that we own across portfolios for diversification: global REITs, which are real estate stocks of real estate companies, had a very similar experience as the broader equity markets. But things like hedge funds, which we own in the DLTG, as well as commodities and other real asset oriented strategies, also perform much better than the broader market and demonstrated their value as diversifiers here in 2022. Just digging a little bit deeper, you've heard in the time that we've worked with the foundation and we've done these webinars, you've heard us talk a lot about style and the impact of style. And style has mattered quite a bit in various short-term periods over the course of the last 5 years. And definitely in 2022, we saw a rotation. For the better part of 5 or 6 or even longer years, prior to the beginning of 2022, the growth side of the marketplace led the way and well outperformed value stocks, those stocks that are characterized by being measured in on some measure of cheapness relative to their growth and balance sheets. Those stocks had performed poorly up until 2022, and we really did see the market change. As interest rates go up, in some of those cases in the value universe, higher interest rates are better for company earnings. That would be the case in a big value sector like financials. And so you can see, as you look along our red circles on our graph here, that the quarter was a strong performance period for each of the value stocks. I mentioned earlier in my early comments that value led the way in the fourth quarter, different from the rally that we saw in the middle of the summer. On a full year basis, though, still pretty challenging overall results. The growth half of the marketplace, though, as I mentioned, did trail. And you can see that the value stocks were negative, but just not quite as much, with better, the largest value stocks holding up the best, and smaller companies still coming under a fair amount of pressure, even though value well outperforming growth. And then you hear us talk periodically about these last two categories, this quality and minimum volatility. Another advantage in the portfolios for 2022 was our dedicated allocation to lower volatility equity strategies. And you can see at an index level for the full year, down about half, if you will, maybe a little less than half of what US markets were, which would be positive contribution to overall results. Just a couple of economic factors today. We've talked a lot about inflation over the last several quarters as inflation rose significantly and then has trailed off. We think inflation may have peaked. Certainly the highest points of inflation we think have peaked, as some portions that were exacerbated as a result of the pandemic, those bottlenecks do appear to be getting worked out. So we're seeing goods deflation pretty meaningfully across the measures. Services is still showing some strength, and clearly we have shown a fair amount of wage and labor strength, perhaps contrary to many's views on the potential for recession. And so we do think inflation rates have come down. We think there is still a fair amount of uncertainty in terms of timing and ability to be able to get to the 2% target that the Fed is after. The market's got a pretty sanguine view on getting there, and you can see that to some extent here in the left-hand chart with the five-year rates. And just as a reminder, these two lines, the blue line represents the spread over a current TIP, or Treasury Inflation Protected Security, relative to a nominal security, basically prices in the expectations for inflation over the next 5 years. It's about 2.5%. You can see that it's fallen pretty far. And the market is forecasting a similar figure for 5 years out by the green line. So inflation expectations have come in pretty far, and the Fed has been quite clear that they don't expect it to be easy, and they don't expect to let up until they can really see, if you will, the whites of the eyes of a 2% inflation rate. That's in the face of moderating economic growth. Growth has slowed down, but as I mentioned, labor remains strong in the US. We have this unique dynamic currently where there are a lot more jobs open than there are people to fill them. And that's creating some labor strength that works, if you will, against the Fed's objectives in trying to reduce overall inflation. And so those are things that we continue to watch, and that also create tension in the marketplace. And in many ways, the big parts of the bond market are pricing in a recession. And they do that. We didn't share at this time, but you've seen us show expectations for the short end of the yield curve. The short end of the yield curve in the US is still pricing in slowness and Fed cuts to short rates as early as 2024 now. That would seem to suggest a much constricted economic environment and growth environment, whereas at the same time we look at the pricing of high yield bonds, or certainly in equity securities more recently, and equity securities don't appear to be pricing in a similar time horizon for a recession. So that tension creates volatility and hopefully creates opportunity for our active managers to add value, but certainly will suggest that we could see a continuation of a bumpy ride as we move here through 2023. So translating that into the building blocks, the components of our overall portfolios, both U.S. equity and non-U.S. equity outperformed in the performed for the full year. U.S. equity outperformed for the quarter, non-U.S. equity just a little bit behind for the quarter. But good execution from both sets of managers in the first, or for the full calendar year, through a combination of the lower volatility strategies, which of course there are components in each of those two pools, as well as just solid outperformance from the preponderance of the underlying managers. So really pretty happy with that. Got a small premium out of our emerging market strategy for the quarter, not as strong for the full year, but those are notions we've talked about. If you recall, we had some exposure to Russia, and that hurt us in the first quarter. But the portfolio has been battling back. Mercer Global Opportunities, as you'll recall, it's about a 5% position in the diversified long-term growth strategy. Underperformed for the quarter and for the full year. You know, in a nutshell, we have more exposure to manager strategies that I would define as pro-cyclical. That is, right now there's a tilt in the portfolio to a little bit stronger growth dynamics and away from some of the more value-oriented strategies. We do have value strategies or value-oriented strategies in there, but we're a little bit more pro-cyclical rather than value-oriented. Also, the global nature of the product, we have a couple of dedicated strategies in European small caps. Those performed less well this last year. And we have a pretty good allocation within the portfolio to two great Chinese strategies, or strategies that are applied in China. They had not a bad quarter, but a pretty tough overall year as China was digging itself out of its COVID environment. That fund collectively is off to a pretty good start here in January, and to the extent that we see these pro-cyclical rallies, we would expect it to do better on a go-forward basis. I mentioned earlier the real assets components and the diversification, and we saw, you know, each of our real asset components in the fourth quarter performed really pretty well. Lazard, through the listed infrastructure, the REIT market bounced back pretty nicely in the quarter, and of course, natural resources, with the, you know, even though the price of oil has bounced around quite a bit and come off its highs, those companies in those spaces, both oil as well as materials, mining, continue to generate strong results as economic recovery, perhaps in places like China, puts additional demand pressure on minerals, mining, and oil as their economy comes back. So we did see some nice participation in the quarter, and some good diversification benefit, primarily on a full year basis from our infrastructure as well as natural resource allocations. And then looking at the more conservative portions of the portfolio, really pretty strong quarter for the hedge fund strategy. As you recall, within the diversified long-term growth, we own the strategy alongside our fixed income allocation and in some ways in lieu of more fixed income. And so not only did we get a nice premium for the strategy versus its primary benchmark, relative to bonds, holding the strategy was about as good as it gets on a near-term basis. About in line for the quarter, but certainly down 2 versus down 14 for the full calendar year is that's a great outcome that we would hope for in this environment. Now that rates are they're not in my mind, they're still not normal, but they are higher for sure, and interest rates are no longer zero. We wouldn't expect this kind of spread going forward. It's just that kind of spread is harder, but we do still like hedge fund as part of the portfolio and as part of the diversification benefit. Within our fixed income manager strategies, we do, generally speaking, have a bias towards corporate credit. And so in an environment where risk was taken off the table, that's an environment where we would expect to underperform, and we did. So no outside worries about our fixed income portfolio at this point, but that's the exact kind of environment that we would expect to underperform, and we did modestly. Though one of the things that helped us, though, in the longer term pools was the performance of our short duration fixed income. We continue to have this strategy in place in our longer time horizon pools as a way to bring down the interest rate risk within those fixed income portfolios. So that, again, similar to my comparison to the hedge fund to the core bonds, if we look at the sterling return of down 3.5 for the 12 months versus the down 14 for the fixed income fund. Again, having lower duration coming into the year and maintaining that position helped to support performance. We continue to evaluate how much and how long we retain this low duration piece, but for the time being, we expect to keep it on. And then, as I mentioned, cash rates have finally come back up. And so with the short end of the curve around 4%, the forward-looking returns for the liquid reserve option becomes a lot more attractive than it has been in recent months. So on a total portfolio basis, what's that translate to? For the quarter, pretty good absolute returns. And for the traditional only longer term pools of active long-term growth and income and growth, slightly behind benchmark, within shooting distance, if you will, or within striking distance of benchmark for the quarter, but a little bit behind for the quarter. Based on those component parts that we talked about. The diversified long-term growth a little bit farther behind, primarily based on that global opportunities performance. And then the ESG fund, again, it's also tends to have a more pro-cyclical or more growth-oriented tilt to it. And as a result, it underperformed a bit in the quarter, but participated pretty nicely on an absolute basis for the quarterly period. On the full year, the two longer term, the active long-term growth and diversified long-term growth with competitive returns versus their policy benchmarks, and in comparison to the passive long-term growth, which has essentially the same asset allocation as the other two, but is all passively implemented in the public markets, a small amount of premium versus that option. So I think we always want to perform by as much as we can. It's nice to get a small amount of premium here through the first part of the year. Or through the trailing part of the year. I don't have all the January performance right now, but I think in some parts we're in pretty good shape overall. So I will stop there and see if there are questions.
It's on mute. Thanks, Travis. So for questions, please put your questions in the Q&A box and we will respond. Let's see what we have. Okay, first question for you, Travis or Tim. Inflation is trending lower going into this February, but the labor market is the strongest it's been in 50 years. What does this mean for future Fed rate increases or possible cuts?
So I'll start and then I'll ask Tim to fill in where I leave out important stuff. I do. And there's a couple of different things to consider here. We're at this unique moment of demographic transition in the U.S. and more broadly so in developed markets outside the U.S., where the baby boom generation is fast approaching retirement age. In fact, the last recognized year of the baby boom in the U.S. is 60 years old. And so we're seeing boomers, we've been expecting to see boomers rotate finally out of the workforce. And one of the largest generations to go through the U.S. in history, stepping away. The next generation is not quite big enough to fill all those seats. And in some way, the pandemic may have pulled forward the retirement of 3 or 4 million people that appear to be missing from the job roles that they might otherwise expect to be out there. So that, I think, is a demographic item that doesn't go away tomorrow. It's something I think that continues to fuel this potential labor mix issue. And there's some other things that contribute to that. So to the extent that labor demand is in excess of labor supply, then that very likely continues to put pressure on the very measures that the Federal Reserve is concerned about in terms of I'll just turn that off so we can see better. That puts pressure on the very things that the Fed is concerned about right now, which is basically services and wage inflation and labor growth. So the Fed's been pretty clear in my mind, and I think our view is the Fed's going to stay diligent until they get closer to that 2% number that is the Fed target for inflation. The market continues to have a different view at times. The most recent pricing I'd seen is the market now no longer expects cuts in 2023, but maybe as early as 2024. And that just feels premature based on what the Fed is saying and the data that as we see it today. If we see labor blow up or we see the economy roll over, then I suppose all bets are off. As the Fed has indicated, they are data dependent. But as it stands right now, our expectation is the Fed will stay diligent and that we wouldn't, they might pause, but we wouldn't anticipate to see rate cuts anytime, 12 to 15 months unless something really changes in the economy.
Okay, a few more questions here. First one here, possibly the sheet's ready, but can you review current asset allocation across the buckets for DLTG, so for diversified long-term growth?
Yeah. So we're I checked the portfolios about once a week, and so last time I looked, we were in diversified long-term growth. We're about a percentage point, maybe percentage point and a half underweight growth assets. So just a little bit underweight growth assets coming into the year. On a underlying, and so our basic long-term target is 75% to growth assets, 25% to risk reduction assets. We're underweight traditional bonds currently, in large part because we're overweight to our hedge fund allocation. And so we are looking at doing a hedge fund rebalancing at the middle of the year. We're probably 2 full percentage points overweight, at least we were last time I looked, entirely based on market movement in 2022. And so that strategy doesn't trade every day. We have to plan rebalances. And so we'll be rebalancing out, but we want to stay pretty close to targets because there is, as challenging as 2022 was, it would have been hard to call that January of 2023 would have been the rocket that it was. And so that's really hard to make those short-term calls, particularly with the kinds of contrary views across the different marketplaces. So we want to stay pretty close to asset allocation that targets. And so we have, within, before it gets out 2% out of that big range, we rebalance and tighten up at the fringes. We're about market weight on world market cap. So for our equity positions, so US is about 60%, probably a little bit less than 60% of the public equity position, about 20% or about 11.5 to 12% maybe a bit more than that in emerging markets, and then the difference in developed markets. So we're pretty close to our overall targets allocations, and that's really on purpose. And then we'll continue to draw those in with the hedge fund redemptions planning for the mid-year.
Great, thank you. Another question here. Do we have any exposure to Adani Group in our emerging markets allocation?
Not as far, well, I'd have to look through to see if we own the shares. That I don't know a lot about Adani, but it's a pretty big company, so it would surprise me if they didn't own some.
Mhm.
But I'd have to take a look, and we can take a look and follow up on that. I would be surprised if we didn't own any, but that's just an educated guess at this point.
Yeah, I mean, we're obviously going to pick them up in some of the passive exposure because you know, India is, I don't know what, 12-13% of the benchmark, and that's a big piece of that India component.
Yeah, so we would have some exposure.
Okay, thank you. Another question for you. Can you talk about, you know, you mentioned it in your presentation about the bond market in 2022, and you know how we have more exposure to corporate credit. But can you talk how we're positioned going into 2023 in the underlying active managers?
Yeah, so I'll start top down. So at the portfolio level, as I mentioned, we're shorter duration, right? So we're about 20% of our fixed income in the longer term pools is targeted towards the low duration strategy versus, you know, a long-term target being all at core. So we're about 20% underweight duration. In both of those portfolios, the tilt is towards corporate credit. Generally speaking, 20% of treasuries or less in those portfolios, more traditional corporate credits, some securitized debt. There's a little bit of what we define as plus categories. So things like there's a little bit of high yield. There'd be a little bit of non-US debt. Those are reasonably small positions, collectively, typically less than 10% of the portfolio. But there's a little bit of that to try and drive for a yield advantage in the portfolio while still staying within a reasonable level of risk. But we're still most focused on or tilted towards what you might consider spread sectors, or those sectors that carry a yield above the U.S. Treasury market. And just to close the loop on that, I mean that there's a lot of conversation about the attractiveness of fixed income, and fixed income is certainly much more attractive than it was 2 years ago, given the change in yields. The yield curve is still inverted, and so there's we get asked periodically, should we be shortening up duration if we're not already short? We are short, and I'm comfortable staying short, but it's a binary outcome. If the yield curve steepens, that is, the rates on long-term yields go up for whatever reason relative to the short end, then our short duration positioning will be advantageous. If the bond market is right and there is some kind of recession lurking on the horizon, then being shorter duration debt relative to our benchmark will be less advantageous, because the longer end yields in that environment might come down faster, and there's more capital appreciation in our core bond position. So being underweight core bond, we might cause a little bit of underperformance versus our benchmark, but we weigh those things in terms of portfolio construction and what risks do we want to protect against. And so as we think about that, we're comfortable remaining shorter duration, but with more credit exposure.
Great, thanks. Another question. Going into 2023, you've seen good performance in January. What other, things that are good along the horizon, silver linings, as I like to call them?
Well, I mean, I think earnings have come out. Earnings have been okay to start the year. I think it depends on who you ask, on which publication is writing it. But I think earnings have been all right. Labor markets continue to be good. So if staying out of a recession and having positive economic growth, maybe not gangbusters economic growth, but positive economic growth is a silver lining, I think we're in a silver lining. I think that silver lining is there. We do expect that economic growth will slow at some point as the impact of interest rates work farther into the economy. Thus far, certainly, we've seen housing be impacted. We've seen both the new and used car market gyrate all over the place. used car prices plummeted, and now I understand they're starting to creep back up. So, but there's other parts of the market that really probably haven't experienced the full force of those interest rate increases. And so as that happens, it's very reasonable that we should see economic growth slow and potentially see a recession. But the longer we put that off, that's good for everybody. More people working, more incomes coming into households, and more potential earning support for the securities, particularly the equity securities that we invest in. So I think those are potentially positive things. The flip side to that is that the market is not in agreement on anything. And so that leads to these short-term bouts of volatility, whether they be positive bouts like we're seeing today, or negative bouts like we saw in December, or maybe in post Jackson Hole in August as market pricing and market expectations realign. So I think we're going to see more of that, and that could shake investor confidence. And that's not a good thing. So that would be I suppose the flip side, and one of the primary risks to the market environment.
Great, thank you. There's no more questions coming in from the audience. If there's any last questions, please type them in now. Other than that, but thank you, Travis and Tim, for being with us today. Really appreciate your time and sharing your insights in market and performance. Thank you to all our participants. Hope you found the webinar informational. And just a reminder, we're posting this recording of the webinar to myFFTC/resources as soon as possible. Thank you, and hope the rest of your week goes well.
Great. Thanks, everybody.
Well, take care.
Take care.